Hello everyone, Clifford Bennett, Chief Economist, ACY Securities, coming to you. Obviously, I hope you recognise the iconic harbour bridge of Sydney Harbour in the city behind me. There's a lot of deep water ahead for the Australian economy. We've seen some interesting data out today. One of those was the Westpac Melbourne Institute leading economic indicator, which basically fell yet again for the fourth month in a row. Ever worsening outlook for the Australian economy from that leading indicator. And in fact, it's been a significant negative for 5 of the last 7 months. And yet you still have people out there suggesting to you that the Australian economy is strong simply because of the unemployment numbers. Well, we saw some interesting data on that today as well. We saw wages up 2.6%. That's the biggest gain in 8 years. And very Australia here, I've just got a brush turkey, can't walk up to my feet. But it's the biggest gain in 8 years, on top of leading economic indicators really falling off a bit of a cliff. But when we look at the wages data and the inflation data, guess what? The diabolical scenario that no one wants to accept that is actually occurring is that Australia is in fact entering a previous century style period now of wages inflation upward spiral. And nothing is more destroying of economies than that scenario. This is the scenario that really the Reserve Bank has been responsible for creating, but also the overstimulus of the previous government, where Australia had the highest per capita stimulus measures in the Western world, or in fact the world, and the lowest number of COVID cases. Hence the economic boom that we've had, both that and keeping interest rates at all-time crisis lows, even though there was no longer an economic crisis. Thank you very much, Reserve Bank of Australia. So moving forward from here, what's clear is the Australian economy is fundamentally weak. And also, just another little anecdote on that, the Financial Review today is reporting that dishwashers and wait staff are now being offered $5,000 bonuses as a sign-up bonus to come and take a job. This is what I've been saying all along. The full employment number that everyone keeps referring to is actually a function of labour disruption. It's not a function of a strong economy. It is not therefore an indicator that the economy is strong. And that has been the only economic data point that really most people have been able to sort of cling to when they're trying to say the Australian economy is strong. It isn't. There's a shortage of people. That's why it's like the overall inflation. It's not because of a strong economy, it's because of a lack of supply. The full employment number is not because of a strong economy, it's because of a lack of supply, both on the immigration front and in terms of temporary visas for travellers and backpackers. I think that might be distracting everyone. So the economy isn't strong. The wages data, the unemployment number doesn't tell you it's a strong economy. It just says we don't have immigration anymore. The wages inflation spiral that everyone said we are not in, we are actually clearly already in now. And all of this is happening as a time, of course, when we know that food and energy prices remain high. Even if they cool at current levels, which they indeed should, they are still debilitating to many Australian hardworking family that's having to change its decision process in terms of food and travel because of these very high prices. So there is an impact on the economy. At the same time, we have the property market clearly turning south. In fact, some suburbs in Melbourne and Sydney are now clearly off 10%. We probably have an oversupply now in southeast Queensland. 5-6 years ago, I was saying to everyone property in southeast Queensland was a great buy. Today, I would say property in southeast Queensland is probably a lighten the portfolio if you can, but you're probably too late scenario. So there are various stresses building, as well, of course, as the general mortgage stress that's building in the background there. And I love when the banks come out and say 70% of mortgage holders are ahead on their payments. Well, what does that say about the other 30%? 30% are just in time or behind. That's a big number. But the headline who wants to focus on, people who want to focus on the low unemployment number and say the economy is strong, also want to say, oh, but 70% of people are ahead on their mortgage payments. There's the other 30%. That's the concern. That's where the stress is. So mortgage stress, high food and energy prices being sustained, even if we don't get an ongoing inflation number of those prices, just they're being sustained at recent levels, is damaging to the economy. And also, let's face it, asset markets, both equities and property, had become fully priced this year with downside risk just on price factors alone, let alone all these fresh economic pressures coming to bear. And we haven't yet discussed the external sector. I do think there is risk of another GFC style, maybe not as severe, but GFC style bursting of the property bubble in the United States. We're already seeing that. A lot of housing data, new home starts, for instance, collapsing. It doesn't look good. And then on the manufacturing front, which is what we saw in the Great Depression actually, was manufacturing and property both sinking at the same time. Manufacturing's clearly rolling over. It's severe contraction there for the New York Empire Manufacturing Index just this week. So not a great outlook for the United States property market. We know the Chinese property market is in trouble, so there is the prospect, the risk that we're going to have a simultaneous China and USA property correction. That's the world's two biggest economies going to property correction phases. For the United States, particularly damaging because they still have super high inflation and they're still going to be raising interest rates. Australia is moving into super high inflation and raising interest rates, and now has an upward wages inflation spiral in play. And then over in Europe, we have the prospect of a serious energy disruption recession. That's very much in the play. We're already seeing some sort of rationing criteria put into place by the German government. The UK is planning to do so. Other countries in Europe will be following suit as we go into winter. It's going to be a harsh energy supply year for Europe. There's no doubt about that. So, for reasons of both lack of supply and refusal of supply, it has to be made, the point has to be made. But overall, the external sector is a slowing global economy, a particularly damaged property market in China, which means the demand for copper going forward, the demand for Australia's resources into China could be tempered going forward, particularly as China has a policy of shopping elsewhere if it can, given Australia's diplomatic attacks against that country in recent years. So I'm not saying either those things are right or wrong, I'm just saying that's why China is behaving as it is. So if they can shop elsewhere, they will. Plus, their overall demand is going to be slower. They're going to be at a permanently slower rate of GDP going forward for the next decade, simply because their economy has become quite mature. So any sort of enthusiasm and euphoria priced into the Australian dollar or the Australian minerals market, resource companies, probably deserves a little bit of a grain of salt moment of thought there. So that's something to keep an eye on. Overall though, for Australia, being an export of raw materials nation, the agricultural sector will remain very, very strong. The mining sector will remain strong, but perhaps below the forecast that some people have been making. The domestic economy really, I think, is in dire straits already, disguised because people have been focusing on that employment number. Thanks very much for listening in. Clifford Bennett, Chief Economist, ACY Securities.